Hey everyone, welcome back to Simple Mind Space. Today, we're getting up close and personal with my own investment journey. Think of this as a casual chat over coffee, sharing what's worked for me as I tried to make my money grow. And trust me, it all started with a simple $100 bill and a healthy dose of curiosity. Now, I'm not promising you'll be swimming in a vault of gold coins by the end of this episode, but I do want to demystify investing and show you that it's not just for Wall Street hotshots. We're going to break down each step I took, from the super safe to the slightly more adventurous. Just remember, I'm an entrepreneur, not a financial advisor, so take this as friendly advice, not gospel. The better safe than sorry fund. Risk level snoozing panda. You know that nagging feeling when you spend a little too much on takeout and your bank account gives you the side eye? Yeah, I wanted to avoid that feeling as much as possible. So I started with the most basic but essential element of any financial plan, an emergency fund. Think of it like having a spare tire in your car. You might not need it every day, but when that unexpected flat tire strikes, and trust me, it will, you'll be thanking your past self for being prepared. I'm talking unexpected medical bills, car repairs, or even your beloved dog deciding to eat your couch cushions. True story. For this financial safety net, I parked a chunk of change in a high-yield savings account. These days, finding a jaw-dropping interest rate is like finding a unicorn riding a bicycle, but even a little bit of interest is better than none. I'm currently liking Marcus by Goldman Sachs. They're offering a decent 0.7% interest rate, which is pretty competitive in this economic climate. Adding a touch of bling, risk level sleeping cat, gold. Just the word sounds expensive, doesn't it? But here's the thing. Gold has been a symbol of wealth and stability for centuries. It's like that one item in your grandma's attic that's suddenly worth a small fortune. Remember those stories of people finding gold nuggets and striking it rich during the gold rush? Well, I didn't quite don my prospector hat and head for the hills, but I did decide to add a bit of this shiny metal to my portfolio. Why? Because unlike the dollar, which seems to lose value faster than ice cream on a summer day, gold has a knack for holding its own against inflation. Think of it as a hedge against economic uncertainty, a safe haven for a portion of your wealth. Now, I'm not talking about buying gold bars and hiding them under the mattress, though it would make for a good story. I opted for a much simpler approach, gold ETFs. These are like digital gold certificates, representing ownership in physical gold held securely in vaults. I bought some shares through Trading 212, a user-friendly platform here in the UK. The slow and steady wins the race approach, risk level, ambling tortoise. Remember Aesop's fable about the tortoise and the hare? Slow and steady wins the race. That's the philosophy behind index funds, a long-term investment strategy that's about as exciting as watching paint dry, but potentially much more rewarding. Imagine a basket filled with tiny pieces of hundreds of different companies. Apple, Google, Amazon, you name it. That's essentially what an S&P 500 index fund is. It's like buying a slice of the entire stock market pie. The beauty of it? You don't need to be a stock market guru to benefit. You're automatically diversified, spreading your risk across a broad range of companies. Plus, index funds have historically delivered solid returns over the long haul. We're talking an average of around 7% per year. Not too shabby for a set-it-and-forget-it investment. Vanguard is a great place to start if you're curious. Becoming a mini real estate tycoon, risk-level curious kitten. I've always been intrigued by real estate, but the thought of dealing with tenants, toilets, and late-night repair calls makes me break out in a cold sweat. That's where REITs, or real estate investment trusts, come in. Imagine pooling your money with a bunch of other investors to buy a giant apartment complex, a swanky shopping mall, or even a sprawling office building. That's the basic idea behind REITs. You get to participate in the potential gains of the real estate market without the headaches of actually being a landlord. Now, REITs do come with a bit more risk than index funds, but they also have the potential for higher returns. Plus, they offer diversification, spreading your investment across multiple properties and often even different geographic locations. I personally invested in a globally diversified REIT through Trading 212, dipping my toes into the international real estate market, taking a walk on the wild side with stocks. Frisky puppy. All right, folks, this is where things get a bit more interesting. and potentially more hair-raising. Investing in individual stocks is like trying to pick the winning horse in a race. There's potential for big wins, but also the risk of backing the wrong pony. Back in the day, I used to spend countless hours poring over financial statements, trying to analyze companies and predict their future performance. These days, thankfully, there are tons of resources that make research a lot easier. Yahoo Finance is like my financial encyclopedia, providing a wealth of information about companies, their financials, and even expert opinions. But let's be real. Sometimes it feels like luck plays just as much of a role as skill when it comes to picking individual stocks. Remember that experiment where monkeys throwing darts at a board of stocks outperformed professional investors? Yeah, it gives you pause, right? So for this particular $100 experiment, I channeled my inner dart-throwing primate. I wrote down a bunch of random company names, blindfolded myself, and let fate decide. The winner? Samsung. So that's where my $100 went, riding on the success of the tech giant. The cryptocurrency roller coaster. Risk level, hang on tight. Let's talk about the elephant in the room. Cryptocurrency. It's the buzzword everyone's talking about, the digital gold rush that's created fortunes and headaches for many. Now, I'm fascinated by blockchain technology and its potential to revolutionize finance. But I'll be honest, cryptocurrency still feels like the Wild West to me, incredibly volatile and unpredictable. But hey, what's life without a little risk, right? So I decided to test the waters with a small investment in Bitcoin, the OG of cryptocurrencies. I figured if it tanked, well, it was just $100. And if it skyrocketed, margaritas on me. I used Coinbase, one of the most popular and user-friendly platforms, to dip my toes into this brave new world. The lottery, more like a money vacuum. Risk level, don't even think about it. Okay, I know what you're thinking. Mark, you've covered everything from savings accounts to crypto. But what about the lottery? Well, I hate to break it to you, but the lottery is about as far from a sound investment strategy as you can get. It's like trying to find a needle in a haystack while blindfolded and riding a unicycle. The odds are astronomically against you. You have a better chance of getting struck by lightning while simultaneously winning an Olympic gold medal than winning the lottery. But hey, we've all been there, that occasional scratch-off ticket purchase, fueled by dreams of early retirement and tropical vacations. For the sake of this experiment, I decided to indulge my inner gambler and bought $100 worth of scratch-offs. The result? Let's just say those tickets lived up to their name. They scratched away my money faster than you can say jackpot. Key takeaways: building your own investment journey. So there you have it, folks. A no-holds-barred glimpse into my own investment adventures, starting with a humble $100. The key takeaway? You don't need to be a financial wizard or have a trust fund to get started. The most important step is simply taking that first step. Start small, educate yourself, and don't be afraid to experiment with different investment strategies. There's no one-size-fits-all approach. What works for me might not work for you, and that's perfectly okay. The key is to find what aligns with your financial goals, risk tolerance, and of course your budget. Remember, investing is a marathon, not a sprint. It's about making consistent, informed decisions over time, writing out the inevitable market ups and downs, and learning valuable lessons along the way. Who knows, maybe we'll both be sipping margaritas on our yachts someday, reminiscing about the time we turned $100 into a portfolio we're proud of. Hey, a guy can dream, right?